This is one of those market facts that sounds impossible the first time you hear it. Silver has been running a deficit for years. Not one weird year. Not one pandemic year. Not one temporary supply hiccup. A real, repeated, structural deficit. The silver market was already in its fourth straight structural deficit in 2024, its fifth in 2025, and the Silver Institute says 2026 is on track to become the sixth consecutive year. And yet, despite that, silver is still down about 42% from its January record high. That sentence should bother you, because most people have a very simple mental model for commodities. If supply is tight and demand keeps outrunning it, price should go up. Not eventually, not in theory. Up. That is the story people tell themselves. It is clean, it is intuitive, and in a lot of markets, it is directionally true. But silver is one of those markets that punishes simple thinking. Because silver can be in a real deficit and still trade badly. Silver can have tight fundamentals and still get crushed. Silver can be structurally undersupplied and still spend long stretches acting like the market did not get the memo. And if you do not understand why, you do not understand silver. The lazy version of this conversation goes like this. Silver is in deficit, therefore the price must explode. Then price does not explode on schedule, and people either get angry, start inventing cartoon explanations, or decide the deficit never mattered in the first place. That is the wrong lesson. The real lesson is harder and much more useful. A deficit is not a magic button. A deficit is pressure, and pressure only turns into price when it overwhelms the structure that has been absorbing it. That is the whole story. Let me make this concrete. Imagine a city using more water every year than it naturally replenishes. If the reservoirs are still big enough, life looks normal for a long time. Faucets still run. Showers still work. Restaurants still open. The deficit is real, but the public does not feel it yet because the system has inventory, buffers, and workarounds. The problem is not imaginary, it is delayed. That is silver. For years now, the market has been pulling more than the annual flow comfortably replaces. The Silver Institute and Reuters have pointed to repeated deficits driven by strong industrial demand, especially from solar and electrification, while supply has remained relatively constrained. In 2025, Reuters said the deficit was expected to continue for a fifth straight year. In 2026, Reuters reported another deficit is projected, making it 6 in a row. So if that is true, why is silver not trading like an obviously broken market right now? Because price is not determined by one number. Price is determined by who has to act, when they have to act, and how much inventory or paper structure exists between the physical reality and the spot quote on your screen. That is where most people get lost. They hear deficit and think, empty shelves. That is not how this works. A commodity can run a deficit for years if above-ground stocks, exchange inventories, private holdings, investor selling, recycling, and futures market behavior keep feeding metal into the system. Reuters explicitly noted in 2023 that while the silver market was undersupplied in 2022, the gap was still being filled by above-ground stocks and metal held by investors and individuals. That is a very important sentence, because it explains why a deficit can be real without immediately creating a straight-line price move. This is where the silver crowd often splits into two equally wrong camps. Camp 1 says, see, deficits do not matter. Camp 2 says, see, price suppression is the only explanation. Both are too simple. Deficits do matter, but they matter through time, through inventory drawdowns, through tighter optionality, through repeated strain, and through the growing difficulty of solving the same supply problem year after year. And yes, futures markets, macro liquidity, margin changes, ETF flows, real rates, dollar strength, and panic deleveraging can absolutely overpower fundamentals in the short run. Reuters reported that silver's brutal drawdown after the January 2026 high was tied to profit-taking, fading rate cut hopes, a steadier dollar, and margin-related pressure. That is the part retail investors hate. Because it means you can be right on the metal and wrong on the timing. It means the story can be true while the chart still humiliates you. It means physical tightness is not the same thing as immediate price discovery, and that is exactly why silver is such a psychologically difficult market. It keeps forcing people to separate fundamentals from timing, and most people do not want to do that. They want one clean narrative where the market immediately rewards the correct thesis. Silver has never been generous enough to work that way. Now, to be fair, silver did not exactly stay asleep forever. Reuters reported that silver surged above $35 in June 2025, hit new highs later in 2025, then spiked to a January 2026 record around 121.64 before collapsing back to the low 70s by late March 2026. So the more honest framing is not why has silver never moved? The more honest framing is, why can a market with 6 straight years of deficit still be down 42% from its own recent peak? And the answer is because silver is being priced by two worlds at the same time. World 1 is the physical world. That world cares about mine supply, recycling, fabrication, solar demand, electronics, jewelry, bars, coins, and whether the market is actually short metal over time. In that world, the deficit story is real and persistent. Reuters says 2026. Demand is expected to remain broadly steady, while another deficit is projected, even with supply rising modestly. World 2 is the financial world. That world cares about speculative positioning, rate expectations, margin requirements, dollar moves, war, recession fear, and whether traders need to liquidate right now. In that world, silver is not just an industrial metal. It is a high-volatility macro asset that can get thrown off a cliff even when the long-term supply picture still looks tight. Reuters reporting on the January and February 2026 sell-off makes that painfully clear. If you do not hold both of those worlds in your head at once, you will keep misreading this market. Let me give you the cleaner reframe. Silver is not misbehaving because the deficit is fake. Silver is misbehaving because deficits tell you about underlying strain, not about the exact day price has to obey. That is the right sentence. Once you get that, a lot of confusion disappears. The 6-year deficit matters because it means the market has been leaning on buffers for a long time. It means industrial demand has not been some passing fad. It means the supply side has not responded cleanly enough to erase the gap. It means silver's floor may be structurally stronger than the chart looks during panic episodes. Reuters noted that most silver is produced as a byproduct of other metals, which is one reason supply does not always respond quickly even when prices rise. And that should really change the way you think about the current drawdown. Because a 42% drop from a blow-off top can mean two very different things. In a weak market, it means the story was fake. In a structurally tight market, it can mean something else entirely. The paper and macro side of the market simply moved faster than the physical side in the other direction. That distinction matters a lot, especially in silver, where the same metal can be treated as an industrial input on Monday, an inflation hedge on Tuesday, a risk asset on Wednesday, and a liquidation source on Thursday. That is why silver never moves in the emotionally satisfying way people want. It does not just price one thing. It prices too many things at once. So what should a serious viewer take from this? First, the deficit story is real. 6 straight years is not noise. That is a structural message, not a coincidence. Second, the 42% drawdown does not disprove the deficit. It proves silver is a volatile crossover market where macro forces can dominate the tape in the short run. Third, repeated deficits still matter because they reduce the market's margin for error over time. The longer a system runs tight, the more fragile it becomes to future shocks, future surges in investment demand, or future delivery stress. And fourth, this is exactly why silver remains one of the most misunderstood markets in the world. People keep asking the wrong question. They keep asking, if silver is in deficit, why isn't the price always going up? The better question is, if silver can run deficits for 6 straight years and still get thrown around like this, what happens if the physical strain ever collides with a real, sustained wave of financial demand at the same time? That is the question, because the chart you are looking at right now may not be proof that the thesis failed. It may be proof that the market is still fighting over when the thesis has to matter, and those are not the same thing. Silver has now run a deficit for 6 straight years. The price is still down about 42% from the high. Most people hear those two facts and think one of them must be wrong. The serious conclusion is harder than that. Both can be true, and that is exactly what makes silver dangerous, frustrating, and potentially explosive.